Greetings. It is Monday, October 14th, 2024. I had three things I wanted to cover real quickly. The first one is big news related to one of the Roundhill funds and those who use Robinhood. Another is an update to Easterly Government Properties, which is a real estate investment trust that we talked briefly about here a couple of weeks ago, I think, and a word about taxes relative to those who are trading in these Roundhill and Defiant and Yield Max and similar funds. First off, for those who have a Robinhood account, RDTE is no longer, as of today, a 100% initial and 100% maintenance requirement. So you can margin your RDTE now if you have a Robinhood account. At E-Trade, there's no change. It's still 50%. And Schwab really hates Roundhill and Yield Max and lots of these funds, and they are under special maintenance at 100%. So it's exciting news for the Robinhood gang. We recently talked about a real estate investment trust that I hold in my portfolio. It's one called Easterly Government Properties. It's a REIT that basically only invests in properties that are leased to government entities. It's been trading between about $13-14 a share lately, yields 9.9%. Those are numbers as of this morning. We talked about a couple weeks ago, Jefferies upgraded it today from a hold to a buy. And as a result, it was up about 3 to 4% throughout the day today so far. The market hasn't closed yet. So that was exciting news. And the last thing I wanted to mention, and this is driven by a comment on the previous video that I'd posted regarding taxes. A lot of people are trading these high dividend, high yielding covered call funds in regular brokerage accounts, sometimes using a lot of margin. I'm not a tax advisor, I'm not a tax lawyer, I'm not a CPA, but if you have not consulted with one regarding the trading in these things, I would advise doing so. And the main reason for that is because you don't want this to happen.
Black and white, clear as crystal. You get nothing. You lose. Good day, sir.
The dividends coming out of these funds are probably not going to be considered qualified dividends at any kind of capital gains tax rate. These are going to be short-term gains taxed at your regular income tax rate. Now, if you're trading these in, let's say, a Roth IRA account, this doesn't apply. But if you've doubled down and you've got huge returns coming in from these funds, you might be in for a uncomfortable surprise when it comes to tax time. We as investors, we work extremely hard trying to squeeze every 1/4%, 0.5%, anything we can to increase our returns and minimize risk when doing so on these funds. To have large gains and then have 1/4 of it, 1/3 of it, half of it, maybe if you're in California, all of a sudden sucked out of your account is a huge step back, and just something I think is worth thinking about for someone who hasn't already been through this a few times over the years. So anyway, that was all I've got for today. Very quick. I might try and do something a little more expansive on the tax implications of some of this stuff in the future, or maybe try and find an expert or someone to talk about it in a video. But other than that, I hope everyone is off to a pleasant start to the week, and take care.